Hello and welcome. Good morning. You're tuned into Market Cafe. I'm Ankita Saxena with me, Shrishti Sharma. In the next 1 hour, we'll take you through how the global markets have fared and what are the cues that you need to keep on your radar. But before we get started with the show, we need to take a cue of how the global markets have fared, especially the US markets, how they have moved. Well, it was a mixed day coming in, as I can see. Dow Jones traded up 55 odd points. S&P 500, though, was very, very flat. Just a 9-point downtick that's coming in. Nasdaq Composite lost almost 0.7% or 172 odd points in the trading session. Now, as of now, even if you look at the futures, futures are down. As far as Nasdaq is concerned, that has lost 0.3%. S&P 500 has lost 0.3%, and Dow Jones has dropped almost 139 points in the trading session as of now. Now, remember, Donald Trump on Thursday night had said that he would announce his choice to replace the Fed chair, Jerome Powell, on Friday morning. In fact, that's the news coming in by Trump on the federal chair, Jerome Powell, that he would want to replace him. Also, remember, Apple shares have inched higher after the company beat the fiscal first quarter earnings and the revenue expectations. That was aided by a significant surge in the iPhone sales. Also, we had the KLA Corp that lost more than 8% on the guidance for the non-GAAP gross margin in the third fiscal. So these are the stocks that are moving as far as Wall Street is concerned. But as of now, the futures have been trading lower.
Well, absolutely a lot of action, and especially a news-heavy day for the US market it was. But along with that, very wild moves when it comes to the commodity basket as well, because just on an intraday basis yesterday, silver dropped almost 8%, while gold actually slipped 6%, and then they recovered actually as well. For now, gold is trading higher by almost 2%, while silver is yet again above that $115 per ounce mark, so not very far from its all-time high levels. So yes, very wild moves when it comes to these precious metal basket. But along with that, seems like it's the crude oil as well, which is seemed to be on the boil, because just yesterday crude oil did surpass that that level of $71 per ounce per barrel mark. And yes, of course, there are issues and there are concerns that what happens to Iran and what could be the next move when it comes to Donald Trump. And as of now, even Brent crude is hovering around that $70 per barrel mark. With precious metals, very wild moves, but along with that, when it comes to the base commodities as well, and especially copper, that surged almost 10% to the record high levels. So let's see how the action pans out in today's trading session.
All right, so that's where the commodities are at. But let's talk more about the geopolitics. The U.S. trade deficit has nearly doubled in November, rising 94% on a month-on-month basis to $56.8 billion, even as Trump's tariffs push continues. The biggest deterioration came from Europe, with the U.S. And EU goods deficit jumping over $8 billion. While the deficit with China narrowed slightly on a year-on-year basis, the overall trade gap is still 4% higher.
And Trump has launched a fresh attack on Fed Chair Jerome Powell, slamming him for refusing to cut the interest rates. Trump said that high rates are hurting the U.S. economy and even national security, arguing that inflation is no longer a threat and borrowing costs should be much lower. Now, reports also suggest that he could announce the next Fed chair as soon as this week.
And the U.S. Secretary of War, Pete Hegseth, has issued a fresh warning to Iran, saying Trump is serious about preventing Tehran from acquiring a nuclear weapon. Hegseth said that the U.S. is keeping all the options on the table, urging Iran to strike a deal and abandon nuclear ambition or face a military response. Let's listen in.
And when President Trump said, we're not getting a nuclear, Iran, you won't have a nuclear bomb, he meant it. And we sent those B-2s halfway around the world, and they never noticed. When he said, we're not going to tolerate trafficking drugs anymore in our hemisphere, we treat them like the Al-Qaeda of the Western Hemisphere, he meant it, and we're executing that. When you said, Mr. President, we're securing the border, the military was proud to do their part alongside Homeland Security to do that. Same thing with Iran right now, ensuring that they have all the options to make a deal. They should not pursue nuclear capabilities. We will be prepared to deliver whatever this president expects of the War Department.
And Apple has delivered a blockbuster quarter with revenue surging 16% on the year-on-year basis, powered by what CEO Tim Cook calls staggering iPhone demand. Now, China led the charge with sales in Greater China jumping 38%, driven by strong upgrades and new users switching to iPhone. Now, while Macs underperformed, iPad sales beat the expectations, helping Apple post sharply higher profits and reaffirm strong consumer demand.
SK Hynix has overtaken Samsung in annual operating profit for the first time as artificial intelligence has reshaped the global memory chip race. Now, the shift is being driven by SK Hynix's dominance in high bandwidth memory, or the HBM, a critical component of the AI servers, where it now controls the majority of supply for the next generation NVIDIA chips.
And Elon Musk's SpaceX and artificial intelligence firm XAI are in merger talks ahead of the planned blockbuster IPO later this year, according to Reuters exclusive. Now, under the proposed deal, XAI shares would be exchanged for SpaceX shares, bringing Musk's rocket Starlink satellites, X platform and Grok AI chat box under one corporate umbrella.
And Venezuela has approved sweeping reforms to its oil law, opening the door for greater private sector control and foreign investment after Washington eased the sanctions. Lawmakers passed changes that allow private operations more autonomy, enable asset transfers and outsourcing, and give Venezuelan oil ministry expanded powers to approve and amend the contracts. The reforms also introduce a new hydrocarbon tax while allowing lower income taxes for energy projects.
Meanwhile, Trump has threatened new tariffs on any country supplying oil to Cuba, escalating pressure on the communist-run island. The move, authorized under a national emergency order, does not specify tariff rates on or target countries. Now, Trump said Cuba is failing and accused foreign suppliers of propping up the regime.
All right, with that, it's time for us to slip into a short break. Don't go anywhere. We'll be right back. Welcome back. You tuned into Market Cafe, where we're getting you all the cues for the morning and the start of D Street. But first up, let's take stock of how the Asian markets have opened up. As far as the implied start to Nifty is concerned, GIFT Nifty is trading down with cuts of almost 109 points. 0.5% downtick is what we see coming in on GIFT Nifty. So expect a negative start for the D Street as well. As far as Asian markets is concerned, that is trading mixed right now. Now remember, even the Wall Street was pretty mixed yesterday, though with the major cuts coming on Nasdaq. We do have Shanghai that's trading down more than 0.5%, 0.6% downtick coming in. Nikkei is very, very flat right now, though in the green it is trading very flat with gains of just 0.09%. And so is S&P ASX 200, very, very flat moves, an uptick of 2 points, very flat moves coming in. Hang Seng Index is trading down with cuts of more than 0.5%. So the China market is trading down, Hang Seng and Shanghai both trading down with cuts of more than 0.5%, and Kospi is right now trading up 1.7%. So it's really the South Korean market only that is doing well in the trading session. Kospi is the only market that is trading with gains of 1.7%, and D Street is also expecting a negative start today.
All right, that's about the Asian handover, but investors are awaiting the inflation data coming out of China, and that is something that we will be watching out for. But with this, let's move on and let's get to the Indian market wrap for yesterday, and Snehi is joining us with all the details. Snehi.
Well, it's an all-round decent move for the market and a very good monthly Sensex expiry move for the market, 0.3% higher on the Nifty. Sensex also seeing similar moves. Nifty Bank outshining 0.6% move coming in on the Nifty Bank. From the Nifty group of stocks, it's names like Tata Steel, L&T, Eternal, Tata Motors PV, Axis Bank, NTPC ahead of its earnings that did very well. On the flip side, some pressure on Asian Paints continues. SBI Life, Interglobe, Maruti Suzuki and Tata Consumer all seeing cuts between 2 and 4.5%. These were some of the top Nifty drags. The broader end of the market closed in the green, no doubt, but yes, underperformed when it came to the benchmarks compared to them. But from the sectoral moves, it was through and through an upward positive day for Nifty Metal, a 3% uptick on the metal index on an intraday basis alone led higher by Hindustan Copper. 20% upper circuit is where the stock was locked in on the back of copper prices. Nalco, Tata Steel, Vedanta, NMDC, Jindal Steel, all of them did well. This was followed by Nifty Energy, Realty and Nifty Bank. You had Nifty Media in the flat line. On the flip side, some cuts on Nifty Auto that intensified with IT, PSU Banks Pharma and Nifty FMCG, the top sectoral loser, lower by about 1%, dragged lower by names like Colgate, Radico, Emami, Godrej Consumers as well as Patanjali. On the flip side, from the broader end of the market, some massive movers. Other than Hindustan Copper, it's GMDC that was up 10%. GE Vernova did very well for itself, a 9% uptick over there. ABB India on the back of its earnings. MRPL, Gland Pharma on earnings. Eclux, that earnings positivity continues. Nalco, Gillette, V-Guard, NLC India, most of these are earnings candidates and most of them did very well. On the flip side, massive pressure on 5-star business on the back of poor Q3, 11.5% cut. KPR Mills, you had Craftsman Automation, KPIT Technology, Escorts, Motilal Deepak Fertilizers and Surgility that ended deep in the red. So that is the outlook, or that is the roundup on what the market did. But yes, for the Nifty, 0.3% higher and overall a well-rounded good day for the markets.
All right, those are the cues to watch out for in today's trading session. But the couple of stocks you need to keep on your radar that will be in focus on the back of news flow. Let's talk about those. HAL being the first one because it has signed a deal with Pawan Hans. That's a contract worth 1,800 crores for the supply of 10 Dhruv NG helicopters and spares execution that is scheduled for completion by 2027. So HAL on the back of that big order win is going to be in focus. In fact, all the defense names have been in focus. We are just a few days shy of the budget, and the defense pack has been in focus on the back of that. The second stock that will be in focus is WeWork India because it has expanded in Hyderabad and signed a lease for 2.5 lakh square feet, and it has already added 3,300 desks to portfolio by June. And on the back of that expansion, it is going to be in focus. Besides that, we also have Power Industries that will be in focus on the back of an order win of 156 crores EPC contract from SE Railways to deploy Kavach-related infrastructure, and on the back of this order win, Apar will be in focus. Praj Industries will be in focus because it has fully validated end-to-end alcohol-to-jet solution, and it is the solution for both ethanol and butanol, and on the back of that, Praj is in focus. As far as Wipro is concerned, it will be in focus on the back of a new launch, a new consulting-led AI-powered operating model designed to modernize core enterprise functions. And the back of this new launch, Wipro will be in focus. Allied Blenders will be in focus on the back of a significant expansion. A manufacturing footprint in the western region, approving already 300 crores worth of ARM Nikashi Agro, and on the back of that, Allied Blenders will be in focus. Now, IndiCube Spaces is in focus today on the back of the fact that its lock-in period ends for 32% of the shareholders, and on the back of that, IndiCube is going to be in focus. And finally, Godrej Properties will be a stock in news because it has acquired 8.5 acres of land parcel in Mahalaua in Pune. That land is estimated, the land has an estimated revenue potential of almost 2,000 odd crores. So on the back of that, Godrej Properties is also a stock in focus.
All right, but along with that, whole host of earning candidates as well. And first up, let's start with ITC, where this time around the revenue has jumped almost 5.7%, but that's the EBITDA growth that has surprised the street with a 7.6% jump that we have seen, and the numbers were definitely better versus the street estimates on the operational parameters. The cigarette volumes did improve, implying a volume growth of 6.5%, and the FMCG growth was also seen to be accelerating by 11%. So let's watch out for ITC. Dabur too reported its numbers. The revenue did jump by 6.1% and EBITDA did grew 7.7%, and the profit was seen at 560 odd crores. Swiggy also did come out with the numbers. The brokerages are not liking the kind of numbers and the commentary with respect to their quick commerce business. As of now, the revenue has seen a jump of 54%, but it's the EBITDA loss that has now widened to 782 odd crores for Swiggy. The quick commerce growth is seen to be moderating as Swiggy is seen to be prioritizing quality over scale. Niva Bupa, when it comes to Q3, the growth is seen at 28% YOY in the NEP, loss ratio at 72.3%. Other than that, Vedanta did also come out with its numbers, very good set of numbers rather, coming in from Vedanta. This time around, we have definitely seen growth in terms of the operational parameters. It's the higher LME, better volumes as well as forex gain that aided the revenue for Vedanta. The management is cognizant of the fact that going ahead, the kind of debt deleveraging plans that they have, that is going to help the company. Upcoming capacity, which will produce higher VAP products, is something that the management is looking forward to. Along with that, when it comes to Dixon Tech, decent numbers posted by the company. It's the flat mobile and the EMS volumes that the company has reported. Consumer electronics demand remained to be muted due to inventory and BEE changes. But brokerages are finding that the growth outlook for 2026 is seen to be moderating. So let's watch out for Dixon Tech. Margins were a tad bit better versus the street estimate at 3.9%. And lastly, Colgate will be in focus as well. The Q3 numbers, the revenue did grow by 1.7%, domestic sales up 2.5%, and is the rebound that was seen and the growth after 3 quarters of decline. And the management notes early positive signs in the core portfolio, sustained strong demand in the premium segment as well. So these are some of the result candidates to watch out for.
All right, with that, it's time for us to slip into a short break. Don't go anywhere. After the break, we'll get you more updates on the market. Stay tuned. Welcome back. You're tuned into Market Cafe, where we're getting you all that you need to watch out for. And let's talk about Prime Minister Narendra Modi, who's interacted with the CEOs and experts working in the AI sector. Now, this meeting comes ahead of the AI Impact Summit that will take place in February. Now, representatives from companies such as Wipro, TCS, HCL Tech, Zoho Corporation, LTI Mindtree, Geo Platforms, Adani Connex, Nextra Data, and NetWeb Technologies participated in the meeting. Prakash Priyadarshi is joining us with more details of this meeting.
Well, ahead of the AI Impact Summit in February, the Prime Minister has held a high-level roundtable meeting with the CEOs and experts of the AI sector. The Prime Minister office has come out with a statement saying CEOs have expressed strong support towards the goal of becoming self-sufficient in AI technology. In fact, they have acknowledged the efforts of the government to make India a leader in AI technology on the global stage. In fact, the Prime Minister has highlighted the need to work towards an AI ecosystem which is transparent, impartial, and secure. He urged companies to work to focus on developing indigenous technology and don't allow their platforms for unethical use of artificial intelligence. A very significant development coming in. In fact, the Prime Minister has also mentioned the need to create an impact with our technology as well as inspire the world. He has supported CEOs and representatives present in the meeting to showcase their indigenous technology, their capabilities during forthcoming AI Impact Summit. A very significant development coming in. Representatives from companies such as Wipro, TCS, HCL Tech, Zoho Corporation, LTI Mindtree, Geo Platforms Limited, Adani Connex, and NetWeb Technologies participated in the meeting.
All right, thank you so much, Prakash, for getting us all those details. But with this, let's move on to another story then. And at the Wings India 2026 in Hyderabad, Samir Kaura with Akasa Air co-founder and CEO Vinay Dubey for an exclusive conversation on the airline vision 2026. Let's listen in.
I hope we are never complacent. So yes, people do say good things about Akasa, but complacency can never set in. For 2026, the calendar year or the fiscal year 26-27, very exciting, right? There's lots of growth on the horizon. We took delivery of 2 aircraft in January. We'll take delivery of 2 aircraft in February. So we've got this resurgent Boeing with increased production rates. And so we're able to ramp up now much faster than we have historically, which is always exciting. I don't share projections of aircraft, but I can tell you that it's a much faster growth rate than we have. We're super excited about Navi Mumbai and Noida International Airport. These are, huge opportunities at these metros. We're equally excited about flying internationally. 25% of our ASKs today are international. We're serving 6 destinations. Over time, it may take 2, 3, 4 years. Over time, we'll get to 40%. But so domestic and international expansion both, along with many aircraft deliveries, is what you can look forward to in 2025. But I hope with the same humility, the same empathy, the same kindness and passion and reliability that we have shown over the course of the last 3.5 years.
But still, I will try to get some sort of headline that, you want to end this 2026 with, 40 plus aircraft, 45 plus aircraft, or maybe when it comes to the international destination part, it's going to be 12 plus or 15 plus.
It's, so in terms of destinations, it doesn't make sense because, sometimes somebody goes in and adds more capacity here. We have to be nimble. We can't be too emotional about our network because our assets are movable. So if one city is working well, we can add more. If something else is not working well, we can reduce. And so we don't think in terms of number of destinations. We think in terms of, commercially what makes sense for us. And these things change over time. Geopolitically, they change over time. From an economic and trade perspective, they change over time. And so it's not something that we get too emotionally, attached to. And aircraft numbers, we never give. I will say that we have so far been the fastest growing airline in the history of global aviation. I can say I don't see that changing. We will continue to be that. Now, whether it's X or Y, either way, I think we'll continue to be the world's fastest ever growing airline.
And well, Samir also spoke to Salil Gupte, the president of Boeing India, on Boeing seeing India as a critical driver of global aviation growth for the next decade. Let's listen in.
The people of Boeing in India all have a singular mission on civil aviation, which is to develop sustainable civil aviation growth that allows every Indian to fly. And I think that's neatly aligned with the goals of the Prime Minister and of the nation. That's why we believe that with India leading economic growth around the world, we believe that the growth of aviation in India will be very significant over the next 20 years. We're forecasting 3,300 aircraft coming into India over the next 20 years. South Asia region, most of which is coming to India. And then 45,000 pilots and a similar number of mechanics that will be needed to fly and maintain those aircraft over that time period. So it is a tremendous undertaking, not just to deliver those aircraft between all of their airplane OEMs, but also to have the pilots and mechanics to support them.
45,000 is such a huge number. And even if, as of now, when we speak, you see the challenge that airlines are facing, the sector is facing is there's a significant gap when it comes to the demand and supply part, the pilot part, the cabin crew part. What role Boeing is playing to, address this big issue?
Well, there's a lot that we're doing. So there's, first of all, the pilot training curriculum. We're moving towards a competency-based training curriculum, which is something that the Indian regulator, the DGCA, has been taking a lead on around the world. This is something that all regulators will move to over the long term, but the DGCA has been leading from the front on this, and we've been proud to support those types of curricula here in India, which is very important. It's a shift away from the traditional task-based pilot training curriculum, and we think that is terrific. That's number one. Number two, we have made an investment of about $100 million over the last couple of years now in terms of simulator capacity, working with our airline partners and our training partner, CAE, to get simulators into India for the 737 MAX, for the 787, to ensure that more pilot training can happen here in India. Because it is, of course, less efficient for pilots to have to go abroad for that commercial training to occur. So we want as much of it to happen here as possible. And I, of course, know that our OEM competitors and peers are doing something similar as well.
All right, and in an exclusive conversation, Samir spoke to Jugan Westermiller, who's the president and managing director of Airbus India and South Asia, on India's strong traffic growth, rapid airport expansion, and a massive fleet build-up. Here's what he had to say.
We have today a backlog for the next 10 years in India of 1,250 aircraft. So simple mathematics, you divide by 10. So we will have an average of 120 aircraft per year delivered to India. So you can say more than 2 aircraft per week, which is a great number, and even peaking it up to 150 aircraft. And this is what also supports the demand of our customer, the growth strategies of our customer, and we are in close collaboration with them to deliver and bring them entry into service.
Outsourcing from India has been one of the key things, and just want to know that in next 5 years or maybe for the next 10 years, what sort of outsourcing numbers or the bigger target that you are looking at currently? Where do we stand? Airbus currently where it stands, and how you're looking to progress?
In the last 5 years, we tripled our sourcing volume from 0.5 billion to 1.5 billion, and at the end of the decade, we will reach at least 2 billion. So tremendous sourcing growth with complex parts.
And well, another big change to the economic survey is the addition of a chapter on monetization of the listed PSUs. Prakash is here to explain more on this.
Well, the government is likely to adopt a new methodology to expedite the monetization of public sector entity, a very significant development coming in. In fact, a chapter has been added to the economic survey on the monetization of listed PSUs, wherein it recommends changing the definition of a government entity by amending the Companies Act. Certain recommendations have been made to expedite the process. Government is finding it difficult in given circumstances, and therefore certain recommendations have been made. In fact, it says that the government can retain control over publicly listed PSUs by holding a 26% stake under the revised definition. That essentially means that the threshold for being classified as a public sector company could be lowered to 26% from current 51%. A very significant development coming in. By doing so, government can ensure stable fund flow and better governance in the public sector company. Along with that, it will also put controversies around privatization to rest. Let's see how it pans out, but the process, but certain recommendations have been made to expedite the process.
All right, thank you so much, Prakash, for all those details. And it's the countdown to a very crucial budget as the government walks a tightrope between its borrowing while also making efforts to boost the GDP growth. So what are the big numbers that we need to watch out for? Ashesha tells us that. Take it away, Ashesha.
Well, yes, just 2 days to go for the union budget to be presented in the parliament. So let's take a stock at the most important numbers that you need to keep an eye out in union budget 2026. And let's start off with the borrowings figure, and both the net borrowing and the gross borrowings figure should come up for you on your screens. First up, the net borrowing figure in FY21. Remember, it stood at about 12.6%. That, of course, is 10.3 lakh crore rupees. It rose to 11.6 lakh crore rupees in FY25, and this year it is expected to come in at about 11.67 lakh crore rupees. Shifting focus to the gross borrowing figure then, in FY21 it stood at about 12.6 lakh crore rupees, and it is expected to come in at about 16.1 lakh crore rupees in FY27. So gross and net borrowing, those are the two figures that you need to keep an eye out on. Shifting focus to income tax collection, and that too has risen steadily over the last few years. In FY24, it stood at about 10.5 lakh crore rupees, and that is expected to rise to 14.5 lakh crore rupees in FY27. So in income tax collection, that's another important figure that you need to keep an eye out on. Shifting focus to GST collection then, and that too has seen a steady uptick ever since it got implemented. In FY21, it stood at about 5.4 lakh crore rupees, rose to 9.5 lakh crore rupees in FY25, and this time we are expecting GST collection to dip a tad bit as compared to last year, and this, remember, is on account of GST 2.0 rationalization, because of which GST collection is expected to see a decline this time around.
and it could come in at about 9.8 lakh crore rupees. So that's another important figure that you need to keep an eye out on. So gross and net borrowing, income tax collection and GST collection, 4 important big macro figures that you need to keep on your radar in the upcoming budget.
All right, so those are things that you need to watch out for in the budget. But with that, it's time for us to slip into a short break. Don't go anywhere. We'll be right back.
India's moment is here. One budget.
Welcome back. You tune in to Market Cafe. We're getting you all the updates on the market. And ITC is one counter that will be in focus today on the back of its Q3 results. It was a steady quarter for ITC. The tobacco major saw a jump in profit and margin with the cigarette segment seeing volume-led gains. My colleague Snehi Shah is joining us with the fine print and what the brokerages are penciling in for the counter.
Well, yes, a largely in-line set of numbers coming in for ITC for the third quarter. Revenue, EBITDA and PAT were in line with street estimates. Margin slightly under pressure on the back of the inflation seen in leaf tobacco prices. But let's take you through what the standalone year-on-year earnings looks like. Revenue is up 5.7%. EBITDA has seen an uptick of 7.5%. Net profit is down 9.5%. But the street was largely penciling this due to the labour code impact as well as any impact of the current excise duty that they've announced, that the government has announced on cigarette makers. So yes, PAT was expected to be under pressure and it has been the case. EBITDA margin, we were expecting around 34.2%, but it's just come at 32.4%. Still, nonetheless, it's a year-on-year uptick of more than 50 bips, but it is still a miss versus what the street was estimating. There's an exceptional loss of 273.8 crores on account of the labour code, and that is heavily impacted the PAT for the company. They've declared an interim dividend of 6.5 rupees per share. Taking you through what the segment performance has been like. For cigarettes, the revenue has been up 8%. Good. Sustained volume-led growth has been seen, but leaf tobacco costs remain elevated. They've also commented on what they feel about the new GST and excise duty norms that the government has set out. They say that this will lead to an unprecedented increase on tax incidence on cigarettes, and this will further give an impetus to illicit trade, and this will cause a steep loss to millions of farmers, MSMEs and retailers. Shifting focus to the MSME segment, revenue did well. Staples, biscuits, noodles, dairy and personal premium care drove growth. Ashirwad Atta, Ashirwad Salt, Sunfeast biscuits, all of them did well. For personal care, Fiyama and Savlon have also done well. The Digital Plus and Organic portfolio, which is their Mother Sparsh and some other brands, the newer ones, are up 60% too. Agri revenue, slight miss versus estimates at a 6.3% uptick. Paperboards also slightly weaker than what the street was estimating at 3% year-on-year. The food tech business has scaled up to 70 cloud kitchens and 4 new kitchens have been added. What the brokerages are making of ITC, Investec has maintained its hold rating, but the target price has been cut, and that has been the story across brokerages, where Investec, Morgan Stanley, they've cut their target price. Citi, Macquarie, JP Morgan, Jefferies and UBS, they've held their stance as well as the target price. So that's the roundup on ITC's quarter 3, largely in line.
So much, Snehi, for that. But what about Dabur? The FMCG major did saw a jump in the profits led by the FMCG expansion. But how are the numbers looking like, Snehi, versus the street estimates?
Well, yes, Dabur also inline set of numbers coming in. Largely, if you take a look at the EBITDA, PAT and margin, in line with what the street was estimating. Revenue, the top line growth has been strong. There's a slight beat over there versus the street estimates, and volume growth also absolutely in line with what the street was estimating. On a consolidated year-on-year basis, revenue is up 6%, EBITDA is up 7.7%, PAT is up 7.2%. Margins have seen a very nominal expansion at 20.6% compared to 20.3%. But the estimate itself was 20.3, so good show on the margin front too. On the labour code impact, there's been an exceptional loss of 15 crore rupees. The India volumes are up 3% year-on-year in line with street estimates. India FMCG growth is at 6%, and international, in rupee terms, the international segment has grown 11.1%. In constant currency terms, it has grown 7.5%. Taking you through the segment performance, home and personal care did very well. Hair care saw overall double-digit growth. You have oral care that saw high single-digit growth. Skin care has seen overall mid-single-digit growth, and home care has also seen overall low single-digit growth. Some moderation here on the home care front on a sequential basis. Healthcare did well. The revenue was up 2.7%. Dabur Honey has done pretty well for itself. Chyawanprash seems to be a little bit of a concerning pocket. The sales have been absolutely flat. Food and revenue, the revenue has seen a downtick. Food and beverages, pardon me, revenue has seen a downtick of about 1%. But their active range, including juices and coconut water, have seen double-digit growth. And yes, so that's the take on Dabur's quarter two. If you take a look at what brokerages are making of this, largely target price hikes coming in on the back of this from Goldman Sachs, HSBC, Investec and JP Morgan. While on the flip side, Morgan Stanley, Macquarie, CLS, UBS, Nuvama and Jefferies have maintained their stance as well as the target price. So that's the roundup on Dabur's quarter three, largely in line with street estimates.
So inline set coming in for Dabur, but Swiggy had a mixed set of numbers for quarter three. The food delivery giant's consolidated net loss widened, while the revenue saw a significant growth of over 50% on a year-on-year basis. Sneha is joining us yet again with all the number crunching.
Well, yes, so if you take a look at Swiggy, a mixed set of numbers coming in, and we'll tell you why these numbers look mixed, because revenue on a consolidated year-on-year basis is good, largely with what the street was estimating, but the EBITDA and PAT net loss pressure on that front, that continues to widen, and that continues to be a problem area for Swiggy's numbers. Food delivery largely in line, and in fact this good show on the top line has been led largely by food delivery. On the flip side, there was a slightly weak show, or a muted show from the quick commerce segment. What's more important is that the management has maintained its quick commerce contribution break-even, margin break-even by quarter one FY27. That's just 2 quarters from now, and they've maintained this timeline despite losses widening and competition going up. So that is something to watch out for. On a consolidated year-on-year basis, the revenue is up 54%, but EBITDA loss and net loss have widened. Advertising expenses have gone up by about 47% on a year-on-year basis, and that's one of the reasons. Segmentally, for the B2C business, overall GOV is up 49%. Average MTU has also seen an uptick of 36.5%. Food delivery, GOV has beat what the street was estimating at 20.5%, and this is their highest growth in 3 years for food delivery GOV. Adjusted EBITDA and adjusted EBITDA as percentage of GOV are in line with the street estimates. For quick commerce, GOV is in line, a growth of 104% year-on-year. AOV is up 40% at 746 rupees, so that also looks good. Contribution margin, adjusted revenue and adjusted EBITDA loss, all of them are miss versus what the street was estimating. Mild miss, but a miss nonetheless. Out-of-home consumption has done well on the GOV and revenue front, beat versus street estimates. The cash balance continues to be at 15,912 crores from the QIB proceeds and their Rapido stake sale as well. In terms of the management con call, they've said that the food delivery guidance remains between 18 and 20% year on year, and they continue to be on the, they will aim to be on the upper end of that. Lastly, in terms of what brokerages are making of this, CLSA has downgraded the stock to a hold rating, cut the target price significantly too. Morgan Stanley, JP Morgan, Jefferies, Citi and Nomura have maintained their stances but cut target prices, and Macquarie, Bernstein and UBS continue to maintain their stance as well as the target price. So that's a roundup on Swiggy. A mixed set of numbers coming in, revenue good, but the EBITDA and PAT loss, that's a net profit loss, have widened.
All right, thank you so much, Snehi, for all those details. But what about Nestle, Snehi? Overall seems to be a good set this time around.
Well, yes, we're expecting to see a good show from Nestle, at least on a standalone year-on-year basis. The revenue is expected to go up by 10.2%. EBITDA is seen expanding by a very healthy 10% too. Net profit, we're expecting to see a jump of around 6.5%. And EBITDA margins are expected to be absolutely flat, but we're not expecting any major cuts there. In terms of key expectations, the domestic volume growth is expected at 7%, which is very strong for a company like Nestle. We're expecting to see volume-led double-digit growth momentum in all segments, barring milk products and nutrition. This has been a segment that has continued to be weak for them, and we're expecting that trend to continue. Exports are expected to go up by 11%. The gross margin contraction is expected to be partly offset by operating leverages and moderation in commodity prices. We've seen a significant cut in the input costs, so that should work out for the margins this time around. But if you take a look at what's going to be important to watch out for when the numbers do come out, we'll be watching out for any commentary on the pass-through or the impact of the GST cuts that we've seen. Cocoa prices, the outlook over there, outlook on other raw materials, their volume trends, pricing strategy and rural versus urban demand, and of course any capacity expansion like they had announced for Maggi last time. So all eyes are going to be on Nestle later today, but we're expecting to see a good show.
All right. Thank you so much for joining us with that. We're completely timed out in this edition of Market Cafe. Shrishti and I will take a leave. Thank you so much for tuning in. And as of now, we can see an implied start of a 0.5% downtick coming in on the Nifty. But with that, it's a wrap. Watch out for the market that's coming up next.
India's moment is here.